Hi, everyone. My name is Ben Pahl. I'm a financial advisor with the Tranel Financial Group in Libertyville, Illinois. Hopefully, everyone who's watching this is staying safe in light of all the very unique circumstances, to say the least, going on in our world right now. So I'm coming to you from my home in Salem, Wisconsin. I live in Wisconsin, make the commute down to Libertyville, Illinois every day. And I'm excited that you're here with us this evening. Thanks for taking time out of your lives to hear what we have to say about the government Thrift Savings Plan. There are some things happening in the Thrift Savings Plan right now that have never happened in the Thrift Savings Plan before. What we're seeing is truly unprecedented, and I'm going to show you exactly what I mean by that by taking you straight to the TSP website and showing you what's happening inside some of the funds in your thrift savings plan, so you can make a better informed decision in terms of how to manage that fund for yourself and most importantly also for your family. You know, as a financial advisor at the Tranel Financial Group, I meet with a wide variety of clients. And the first time I meet with them, very first time I ever sit down with them, we call that first meeting a discovery meeting. And in that meeting, it's a get to know each other type of meeting. I'll learn a lot about you as a client. You'll learn a lot about myself and about our firm. But what always holds true, regardless of who I'm talking to, is when you get down to the nitty gritty of really what's important to them and their life, it generally comes down to their health, their family, their money, and their religion, depending on who you're talking to. So health, family, and money. So right now, more than probably ever before, our collective world is paying close attention to their health. You know, health is top of mind right now for just about everybody on the planet. Staying healthy, staying safe. With everything going on right now in our world, everything going on in the economy, stock markets are gyrating up and down. So naturally, money is top of mind right now for a lot of people. Some people are losing their jobs. Some people are having a hard time paying their bills because they lost a job. 401ks, thrift savings plans are fluctuating. So money is very much top of mind right now. And then, of course, family is top of mind. We can't interact and be with and see family like we're used to. We're worried about our loved ones, especially those in a more high risk category. So it's just amazing that these three things that we always place emphasis on in our lives, but these three things are very, very front and center, maybe more so than ever before in a very literal way. Health, family, and money is top of mind across the board. And yes, it's always on the mind and it's always important, but there's never been such a spotlight and such an intense focus on that as there is right now. So at the Tranel Financial Group, financial planners, much of what we do, of course, revolves around the nuts and bolts of financial planning. But when you can help someone with their money, it helps them provide for their family, helps them spoil grandkids and take vacations and put food on the table and buy houses and pay for college. And of course, that helps family and loved ones. So money and health and family are all very intertwined. This webinar specifically is going to last about 30 minutes. And I'm going to be taking you to the TSP website here via a screen share. And I just want to enlighten you on some very important things you need to be aware of as a thrift savings plan participant. So with that said, let me share my screen here. Just bear with me. All right. Very good. So now you can see the screen here in front of me, and of course this is at tsp.gov, and this is the TSP fund lineup. So you've got the G, F, C, S, and I fund. So the G fund is your government securities fund. The F fund is fixed income. The C fund is common stock. The S fund is small cap. and the I fund is international. And yes, there's L funds as well, but L funds are just different combinations of G, F, C, S, and I, and it's based on how old you are and what year you plan to retire. You would pick an L fund that might be most appropriate for you. So with that said, G, F, C, S, and I, just remember CSI, CSI, crime scene investigation, however you need to remember it. CSI, the CSI funds are the equity funds. Those are the stock market funds. So the C fund, you don't have to remember this, but just for sake of sharing it with you, the C fund is the S&P 500. It's the common stock market. It's a US stock market fund. The S fund is small cap. So there's those small cap companies, not large S&P 500 type companies, small cap type companies. And that will generally follow the Russell 2000 index fund. And then I fund, I stands for international. And those are, of course, international stocks, not stocks of companies based here in the US, but rather international. So CSI are your stock funds, and the G and F are your government bond fund, and your F is your fixed income fund, which is bonds as well. So G and F, call it bonds. CSI, call it stocks. Now, what's happening inside these funds right now is absolutely unprecedented. All right. The G fund is your guaranteed principal option. All right. The federal government guarantees principal will be protected inside the G fund. It says it right on their website that it's made to be a safe haven for money inside your TSP. Now, the G fund interest rate tends to track roughly what's known as the 90-day treasury bill. So whatever rate roughly that the government 90-day treasury bill is paying, the G fund is indexed to that. So let me bring this to light for you now. As you can see my screen here, I'm going to pull up a fact sheet for the G fund. Right now, this G fund fact sheet, this is directly from their website. You'll notice they have a nice little graph here that shows in orange the historical growth rate. If you had $100 invested in 1987, it shows the growth rate of that $100 through December 2019. So $100 invested in the G fund in April of 1987 would be worth $485 today. So round numbers, about $500. So you would have 5 times the money since 1987. But here's what you absolutely must understand. I want you to think back to what interest rates were like back in 1987. Now, some of you watching this webinar might not have even been born yet, and some of you are laughing at that comment right now because you were probably buying a house or making a home purchase possibly right in the thick of the late 80s. And you might remember what interest rates were back in the 80s. In fact, I've got a little snip here. If you take a look at this, I promise you I'm not going to bore you with a chart that goes too deep into detail, but this chart right here shows the federal funds rate, which is basically the Fed rate that gets all the publicity on TV. And you can see here that in the early 80s, you're looking at interest rates in the high teens. So if I put my cursor here at 1987, when the Fed funds rate kicked off, I mean, you're talking interest rates in the double digits, 8, 9, 10%. Early 80s, they were in the high teens. So when you look at the performance numbers of the history of the G fund, it takes some really big interest rate years into account that just aren't even remotely possible these days. And when you scroll down further on the G Fund fact sheet, they actually do a pretty good job of laying that out for you. So here's your G Fund interest rate, like I mentioned, in the late 80s, being just about 9–10%, like we saw on that chart. 9–10% in the late 80s. Since the late 80s, interest rates, the T-bill, so the gray is that 90-day treasury bill that I mentioned the G Fund will tend to correlate with. So as interest rates, as the Fed has lowered interest rates over the years, as the Fed lowers rates in their T-bills, naturally the G Fund reduces its rates too. Now here's the kicker, all right? This particular fact sheet that they publicize, they only publicize these once a month. So this is as of the end of December, and you can see here, if I take my cursor and I just kind of follow it over to the left side of the graph, when the year started, the G Fund was paying about 2%. But you might also know that the Fed slashed interest rates to 0 in February and March. There were numerous interest rate cuts in February and March. And if I go back to where I just was, you can see here that the Fed really can't even go any lower with its interest rate right now. You can see how it ticked down. The Fed rate right now is literally 0. Now that does not mean the G Fund is 0, but the Fed rate is 0, which will cause the G Fund to trend down. Now, take a look at this. These are the monthly return numbers for all of the TSP funds. And here's your G Fund right here. And here you'll see 2020, that in the month of March, the G Fund paid 0.11%. The month before was 0.13, January is 0.17. So as the Fed has cut rates on their 90-day treasury bill, rates of the G Fund will follow suit. If I take 0.11 interest and I multiply that by 12 months, that's an effective current yield of about 1.32. So if you annualize the rate that was just paid in March by the G Fund, it comes out to 1.32% annualized. I share that with you because a lot of TSP participants have the misconception that the G Fund is paying 3%, 2.5%. And it used to be, but it's not anymore because the Fed had to cut rates so low, went all the way to 0, that there will likely be continued downward pressure on the rate the G Fund is paying. Now here's the challenge. For those of you listening right now, we know the government is spending a lot of money, trillions of dollars in stimulus relief as a result of the coronavirus, trillions of dollars. More spending, more stimulus, more money supply eventually leads to inflation. Inflation means that your dollar today isn't going to be worth $1 tomorrow. You'll still have that dollar, but the value, the spending power of that dollar will be less. So you're in a tough spot with the G Fund because inflation will go up, which inflation will rise faster than the pace of that G Fund potentially. And that's a very risky spot to be from a time value of money standpoint. Now, is principal protected? Yes. G Fund is stone cold, safe and secure, but likely going to lose ground to inflation. And I mean, let's face it, you don't necessarily want your money earning you 1.5%. It's just not doing something for you. You work hard for that money. You need to make sure that your money is working hard for you. Now let's talk about that. Okay. Another option that I see a lot of TSP folks flock to is the F fund. Now the F fund is very interesting. The F fund is a pure bond fund, and it's important that we talk about here just briefly. It's important that we talk about the difference between interest rates and bond funds and how those relate to each other. So on my screen here, you'll see there's a very simple graphic. As interest rates go up, bond values will fall. Okay, I'll say that again. As interest rates go up, bond values will fall. Right now, interest rates are at an all-time low. They're at 0. Interest rates can't help but go up over time. As interest rates go up, bond values will fall. It's a mathematical reason. It's a mathematical reason why that happens. Now, what's interesting, let's take a look here now at some annual returns, not monthly, annual returns of the F fund. You'll notice in 2013, the F fund lost money. So the F fund went down. But if we look at the federal funds chart in 2013, you can see interest rates were flat during that entire period. So why did the F fund lose money if the Fed did not raise rates? Well, I'll show you. Bear with me a second. If I type in Ben Bernanke, 2013 Fed rate hike, and we just simply Google that, you'll see headline after headline after headline about stimulus being over, the Fed getting ready to raise rates. Just the mere threat that the Fed was going to maybe raise rates in 2013, even though they didn't raise rates, just the fact that they were talking about it in 2013 caused the F fund to lose money. Now, when we look at when rates did start going up, 2015 to 2020, or 2015 through part of 2019, those were some very lean years for the F fund, 0.91, 0.15. It was only in 2019 where the Fed started cutting rates again that the F fund started to rise. And that's why we saw this nice positive bump in 2019, because the Fed started lowering rates. I share these little examples with you simply to prove to you that interest rates and bond values move in opposite directions. The moral to this story is interest rates right now are an all-time low. As interest rates go up, bond values will fall. I see so many TSP participants, they treat the F fund as their safe haven. They'll look at the 10-year of the F fund, or they'll look at last year of the F fund and say to themselves, well, that looks pretty good. That seems pretty safe. And they'll put a lot of money in the F fund or a lot of money in the G fund because they're looking to be really safe. The F fund right now, because interest rates are so low, and as rates rise over time, those bond values will fall. There is a lot more risk in the F fund now than there ever has been before. And that is a fact because rates are at 0. Rates are at 0, rates can only go up, which means that bonds can only go down. That is unprecedented to have the G fund where it's at right now paying 1.32% and have F funds actually shouldering a lot of burden or a lot of risk burden for investors. So be very, very careful with the G fund and the F fund. Now, it sounds weird to say that because obviously the C fund, the S fund, and the I fund are all equity-based indexes. They're stock markets. But I would wager, just for sake of comparison, you look at where the C fund is and the S fund and the I fund. Warren Buffett has a very famous saying. Warren Buffett has a saying says, be greedy when others are fearful and be fearful when others are greedy. So right now, there's a lot of fear baked into the stock markets, a lot of uncertainty. And am I recommending that you throw all your money in the C fund and the S fund and the I fund? Absolutely not. I'm not making that recommendation at all. But when you look historically at good times to buy, you always hear the phrase, buy the dips, buy the lows, right? Buy low, sell high. And I could make a strong case to allocate some of your TSP to CS and I. But of course, I cannot make that recommendation, not knowing you as a person right now, not understanding your risk tolerance or your goals or your objectives. So I by no means am recommending that to anybody. That's a decision you need to make on your own, or more importantly, work with a financial advisor, a professional who can help guide you down the path of making a right decision for yourself. So the situation now is when you look at those annual returns, I beg your pardon, the monthly returns of the CS&I. We talked about the G and the F. Let's talk about the CS&I funds now. Naturally, year to date, when you look at those C, S, and I funds, those funds have taken some huge losses. Now, if you're a young investor, you know, if you're 10 years or more away from retirement, yeah, you know, it's not fun seeing those negatives. That's nothing new though. We've seen those types of negatives before. In fact, fourth quarter of 2018, the market was down 20%, just that quarter. So that these returns are not unprecedented. How fast they happened was record-breaking. We haven't seen declines that fast since the 1930s, but the level at which it drops, we've been through that before. So if you're a younger investor, I would encourage you to give some serious thought to really allocating money to the equity investments, the C, the S, and the I. Now, if you're a little older, if you're closer to retirement, maybe you're 55 and you're gonna retire when you're 62, when you're 60, right? If you've got a shorter runway to retirement, you're definitely gonna want to take more of a balanced approach. You should not put it all in the G fund. You should certainly not put it all in the F fund. You're gonna want to use a mix of G, F, C, S, and I. And I would even say not even invest in an F at all at this point. But again, you gotta make that decision on your own, or consult a financial professional before you make that kind of decision. Now the question I get a lot, and this is why we're doing this particular webinar. A question I get a lot is something along the lines of, well, Ben, I'm 60 years old, or I'm 62. I want to work till I'm 65. What should I be doing with my TSP? What should you be doing with your TSP? The challenge with the TSP right now, and this is what makes it really unprecedented, is the G fund's not paying anything. The F fund has a lot of risk built into it because as interest rates go up, bond values will fall. And there is a lot of risk to the broad market right now. The C fund, the S fund, and the I fund are broad investment vehicles. So those broad investment vehicles own a little bit of everything. Right now, they own airlines and hotel chains and restaurants and banks and bricks and mortar retail. In the C fund, the S fund, and the I fund, they're so broad, owning a little bit of everything, you end up owning a lot of things that you would rather not own, things you'd rather not be invested in right now because of all the economic risk associated with the coronavirus. So the opposite of going broad is going narrow. So I think I've made a pretty good case to, in general, stay away from the G fund unless you are just a stone cold, absolutely no risk whatsoever type of investor. Then the G fund would be very suitable for you. But earning less than 1.5%, losing the battle to inflation over time, yes, it's safe, but there's risk to that too from an inflation standpoint. I think I've made a good case that the F fund, as interest rates go up, bond values will fall. There is some serious risk in that F fund. So that leaves us with CS and I, and those three are tough options. Those are tough because they're broad. And when you go broad, you own stuff that you'd rather not own. So one of the solutions that we've come up with at the Tranel Financial Group is we created a custom investment allocation for our clients. So take a look at this. This is a custom allocation that's run by our firm. We call this allocation the Tactical Growth Solution. And if you are a Thrift Savings Plan participant and you're over age 59 and a half, you have the ability to do an age-based in-service rollover from your TSP into Tactical Growth Solution if it's appropriate for you. We have a lot of other allocations too. There are a lot of other firms out there as well, but a lot of firms will use mutual funds and ETFs. This particular allocation that we run custom for our clients at our firm, as I scroll down here and you look at the list of names, you look at the names of the companies we invest in. These are not mutual funds. These are not ETFs. These are individual equities. These are individual equities in companies like Clorox, Waste Management, Procter & Gamble. Don't go broad. Don't go broad and be at the mercy of the market, because sometimes the market shows no mercy. By going narrow and zeroing in on just the companies that you want to own. Now notice, what I want you to notice here is all of these companies, all the companies you see here on the screen fall into one of 6 sectors. And all the sectors are listed right over here. There's consumer food, consumer staples, energy, utilities, telecom, and pharmaceuticals. Because no matter what's going on in the economy, people still pay their electric bill, they still pay their cell phone bill, and whatever prescription drugs they're taking, they're going to continue to take. Waste companies like Waste Management and Republic Services, those are garbage collection companies. It doesn't matter what's going on in the economy, people are still going to be throwing their garbage away. And companies like that are still going to be collecting revenue. Think of what a great year Clorox is having with selling bleach and Clorox wipes. Procter & Gamble, Kimberly-Clark selling toilet paper and Kleenex, tissue paper, toothpaste, razors. Demand for these items does not go down in general, even under these most difficult of economic circumstances. So when you have the ability to go narrow and really zero in on specific holdings, in my opinion, and again, this is not direct advice to you because I don't know your situation well enough to give you this kind of advice, but I'm sharing this with you to educate you on what's out there. In my opinion, this is a reasonable spot for an investor to park a portion of their overall retirement savings. Now, again, you have to take that with a grain of salt because I don't know you well enough to give advice, but just appreciate that in the spirit that I'm coming to you with. What I love about this mix of holdings that we manage for clients is this mix of holdings. Every single company on this list pays a dividend. Every single company pays a dividend. And not only do they pay a dividend, but generally speaking, they pay a strong and consistently increasing dividend. Is it guaranteed? No. Historically speaking, have these companies done a phenomenal job of increasing their dividend? Yes. Does history always repeat itself? No. But let me show you this. This is a piece that we publish about the tactical growth solution. And what's amazing about this allocation is so far this year, when I highlight January through the end of March, so far this year, 11 different companies inside this allocation have increased their dividend. Not only have they paid it, but they increased it. Four of those companies, I beg your pardon, three of those four were raised in March alone. So while the economy, the stock markets are crashing, and the economy, I mean, layoffs and interest rates going to zero, 4 companies of the 24 that are in this account increased their dividend in March. You've got 1, 2, 3, 4, 5, 6, 7. 7 companies increased their dividend in January and February. So not only do these companies pay a dividend, but they consistently increase their dividend. And that leads me to the last concept I want to share with you that we refer to as the double compounding effect. I just showed you how all these companies, how those 11 companies have increased their dividend year to date. As you reinvest your dividends, you buy more shares. When you buy more shares, you get more dividends because dividends are paid to you based on how many shares you own. So the more shares you own, the more dividends you receive. You receive more dividends, you buy more shares. You're compounding the number of shares that you own. Not only are you buying more shares, but the amount you're getting per share also increases as the companies you invest in are increasing their dividend. So what effectively happens when a TSP participant who's, let's say, 61 years old, they're over 59 and a half, and they ask me, Ben, what are your thoughts for what you should do with your TSP in the last few years before you retire? And my advice to them is generally what you want to do is protect the income power of your TSP regardless of what's going on in the markets, right? You want to make it so the fluctuation of your money, you want to make it so the fluctuation does not make your income power go down. Because let's face it, if you were in the G fund, I beg your pardon, if you were in the C, S, or I fund, your income power is down because you have less money in those funds. But if you used your TSP and you buy a basket of good quality dividend paying equities in recession resistant sectors, then you're buying shares in all the companies. And when you buy shares, dividends are paid per share. So even in this first quarter of 2020, even in the first quarter, if you would have bought shares on January 1st of this year of all these companies, your income power would actually be up. Your income power would be up because you are getting more per share, and you would have reinvested your dividends for a quarter to buy you more shares. Retirement planning is all about income planning. It's all about cash flow planning. And there are ways to protect and preserve and over time potentially grow the income power of your money, even if account values go down. Because just because the share prices come down a bit doesn't mean the dividend comes down, which means the income power is insulated relative to the fluctuation of the markets. Now, are there companies out there right now that are cutting or eliminating their dividends? Absolutely. You'll read headlines about all sorts of companies in the coming months that will reduce or eliminate their dividends. But we feel very strong about the dividend paying potential of these companies. There's a lot of airlines that are likely going to cut or eliminate their dividends. There's a lot of hotel chains and restaurant chains and retail shops, retail companies that'll go out of business. All those types of companies are owned inside of the CS&I funds. Again, CS&I, they go broad. They go very broad. You end up owning a lot of things that you'd rather not own. You need to go narrow. So this is why, as I bring you back to where I started this webinar, this is why it's so unprecedented. You've got the G fund paying next to nothing in interest rate. Nothing in interest rate. Principal protection, yes. Earnings power, no. You've got the F fund where interest rates are at historic lows. And as those rates go up, your bond values will fall. So you will find little to no appreciation inside the F fund moving forward. You'll get little to no appreciation in the G fund. So conservative investors don't have a good option in the TSP these days, which is very sad to say, but it's also very unique. It's why we're doing this webinar. The CS&I funds are very broad. You're going to own a lot of things that you'd rather not be owning right now. So your only choice in the TSP is go broadly very aggressive, or go to the G fund where you're not going to earn hardly anything. So the choices are binary. Your only choices are ultra conservative with no appreciation, or ultra aggressive, taking on all the risk of the broad markets, and there's just no in between, because the G fund or the F fund is going to be working against you too. All right, so this is a big deal. Again, if you're young and you can throw money in the CS&I funds and be invested for the long term, that's a good thing. But for those of you 55, 60, 65 years old, 70 years old who are already retired and have your money in the TSP fund, you're in a tough spot with the TSP. It's never been like this ever before, ever. The G fund has never been this low. The F fund has never been at a point where it can only go down as rates rise. And there's a ton of risk built into the broad markets right now. So it's a tough spot to be. So I strongly encourage you to seek the help of a financial professional. Hopefully those of us at the Tranel Financial Group, in terms of working with us, it's a great team. I'm happy to be a part of a really phenomenal team at the Tranel Financial Group. We manage money and give advice in some very unique ways. These allocations, how we manage the dividend, and how we allow investors to take advantage of the double compounding effect, double compounding the income of your money. We want to insulate the income power of your money from the fluctuation of what's going on in the markets. Now, I just shared, I shared a lot of information here with you, a lot of information, and I'm excited. Oh, I beg your pardon. 1 second there. There we go. Sorry about that. So I'm excited to bring you this information. All right, I probably got a little more technical in this webinar than you were anticipating, but the information is good. These are some facts, And in order for you to make good decisions about anything, you want to be armed with the facts. There's a lot to know about the TSP. It seems simple when you think of just 5 funds, GFCSI. I give TSP credit. It is a simply constructed investment vehicle. But there are some nuances to this TSP plan that are more evident now than more important to be cognizant of now than ever before. G fund, F fund versus CS and I. Educate yourself on these funds. Work with a professional. It's more important now than ever before. Folks from our office will be following up with you in the next day or two just to say hi, touch base, see if any questions came to mind as you were watching this TSP webinar. We will be sending this recording out to all of you as well. I encourage you, share this recording with your coworkers that are federal employees. Share the recording with retired friends and family that are invested in the TSP. These are very, very unique times for a variety of reasons within the Thrift Savings Plan. I thank you so much for your time here this evening. Thanks for bearing with me as I went through some of the more technical aspects of the TSP. Stay safe, and we'll be following up here with you real soon. Have a great night.